Good evening. I'm Mike Cadwell. I am the director here at the Knowlton School of Architecture, and it is my great pleasure this evening to introduce Dr. Rachel Kleit, who is my colleague and also our new section head of City and Regional Planning. Dr. Kleit received her bachelor's in history, cum laude with highest honors at Brandeis University. She received her master's in urban and environmental policy at Tufts University, and then got her PhD in city and regional planning at the University of North Carolina at Chapel Hill. Upon graduation, she taught at the University of Washington, Seattle, eventually becoming associate professor in two departments, public affairs and urban design and planning. During that time, she amassed a rather impressive resume of journal articles, chapters in books, book reviews, reports and case studies, honors and awards, and more than 49 talks and presentations, all the while serving on numerous university and community boards and organizations. As varied as this resume seems, she's been single-minded in her research, and that research, which she will share this evening, deals with the social impacts of housing, particularly on the poor. And when we think of housing, we want to think of the fact that we normally associate this with a standard of living, with the way in which we live. So it's not just an economic thing, it's a social thing. And Dr. Kleit has been single-minded in exploring those implications, particularly of late with the recent mortgage crisis, which has had a devastating impact on particularly the poor, but on the middle class as well, who have been prevented, by and large, from making the single most important investment that they could make, that is, owning a home. There is a buzz. Of interest, perhaps. From that mic. Do we know where that bus is on? Good, because this is my kicker point here. It's Halloween. And you might wonder at the timing of a lecture on Halloween. And the reason should be self-evident now, because the mortgage crisis was brought about by a trickery of the highest order. Those of you who have followed it realize that it was both transparently obvious that it could not pan out, while using the most labyrinthine mathematical calculations to justify that it would work out. So this is trickery of the highest order. Well, at the same time, the treats were suffered only to the very wealthy few, while the rest of us, and particularly the poor, suffered the consequences. So it was trick without a treat. The treat comes tonight, as Dr. Kleit will explain its implications.
Thank you. Thank you, Ricky. Thank you, Mike. I don't think I've ever been introduced in quite that way. But really, I do. Yeah, really. I hope I don't fall on something and make my presentation disappear like I did in my job talk. So it is a pleasure to be here tonight to speak to you, and I want to thank you for that opportunity. So this is a paper, actually, that I've been working on for a couple of years with a doctoral student at the University of Washington. And we originally started thinking about what the relationship was between housing and inequality. And housing is usually thought, your housing situation is usually thought to be produced by inequality. In other words, you afford a certain kind of house in a certain place. But we argue in this paper that it's actually quite the reverse, in that your housing situation can influence your social standing. So what we know is that inequality in both income and wealth has grown rapidly in the US since the 1970s, and over the same period, we've seen increasing affordability challenges. That's the most prevalent kind of housing problem that we face today in the US. We also saw homeownership become the largest economic investment and source of wealth for households in the US. But as Mike mentioned, the foreclosure crisis and the Great Recession of the 2000s have stretched households financially and weakened those traditional economic benefits. And these blows, something's buzzing. If I touch it, it goes off. So these blows to household economic stability really implicate homeownership itself and affordability and that widening gap between the rich and poor in the US. Maybe it's my lamp that's doing it. Yeah, that's what it is. I'm sorry, I can't see my notes anymore. I'll have to end the talk now. So I want to first tell you the question we were asking, which is, homeownership is supposed to decrease societal inequality through its wealth-generating benefits. And the question is, after the foreclosure crisis, is this still true? So we've had policy in the United States for 70 years of encouraging homeownership in one way or another. You may recognize these photos, some of you, as pictures of Levittown. So we did see in the middle part of the 20th century the growth of the suburbs. Well, with that growth was the increase in the single-family home as an expectation, perhaps, of people in the US. And we had policies that promoted that. We have the FHA insurance program, Federal Housing Administration insurance program, VA loans in the wake of the World War II, and of course, the home mortgage tax deduction, which cost the federal government $100 billion annually in lost revenue. So if you're a homeowner, you get to take the interest you pay on your mortgage loan and deduct that from your taxes. So this was really good for the middle class, especially in the post-war era when we had a really booming economy. We did have some recessions, but basically it was a good time to be working. But not everyone benefited equally from these policies. Let's see if I can figure out how to use this. So at the same time that we had this broad expansion in home ownership, we also had an unequal access to credit. So this is a map of Pittsburgh's, which was made by the Homeowners Loan Corporation in 1937. And this is a map that's typical of the 239 maps that the HOLC made at that time. Now, the HOLC came about because of a mortgage crisis, actually. People were getting foreclosed on, and the HOLC was supposed to purchase the loans and help to save those homeowners. In fact, in some cities, they purchased the loans, and then African American and Jewish and communities, instead of helping those folks, they actually foreclosed on them and turned those homes over to other folks. In this situation, the interesting thing about this pattern is that these patterns, there's some research about how the patterns that were set in these maps continued through 1960s lending patterns and then reverse redlining that happened during the mortgage crisis. So there's a little key. How do I do this? A little key down here. And the green, which is sort of hard to see in this light, but that's green. The green, those are places that are desirable, neighborhoods that are desirable. The blue, the green is the best neighborhood. The blue are the ones that are still desirable. The yellow are the ones that are declining. And the red neighborhoods were called hazardous. So to get a mortgage, if you lived, eventually what happened was the Federal Housing Administration loan program, insurance program, used these maps as the basis for where they would insure. And they would insure loans in particular neighborhoods, especially those that were called hazardous, thus increasing our divided housing or segregated housing patterns. But in the 1970s, we had some legislation that tried to, I can't do that over here, tried to deal with some, oh, that was very interesting. Hold on. that tried to deal with these disparities in lending and access to credit. So the Home Mortgage Disclosure Act required and still requires banks to report who they lend to, their race, what the mortgages are, what kind of mortgages, frequency, who got a mortgage, who didn't get a mortgage. So there's been a concern since about the 70s in giving people fair access to credit, and that's pretty important if you actually want to increase home ownership. Oops. So one of the ways in the next generation of increasing access to credit was the growth of subprime loans, which you've heard of, and they've been vilified. These are loans that, so a typical loan is a 30-year mortgage with a fixed interest rate. You put 20% down, you get a nice interest rate. And these loans those are loans that are given to people with good credit, usually. Subprime loans were given to people supposedly who had bad credit, who couldn't afford a mortgage payment in that same way or didn't have enough income. And so they were considered higher risks, they paid more fees. And so in the wake of the crisis, of course, this became a huge risk. And we saw, how can I do this? Sorry, I seem to be, Jeff, can you help me with this? I'm not really understanding what I'm doing. There we go, okay. So and the subprime loans have gotten tied up with the whole foreclosure crisis, in that the folks who got these subprime loans usually did not have fixed interest rates. And when that interest rate changed, increased their payment, they were often unable to make those loans. Oh, and by the way, they were made to people who couldn't afford them, which I'll talk about a little later. So this is just a broad overview of kind of the lay of the land that we've seen in the past 10 years or so. So we have all that going on, but we also have, since the 1970s, increasing income inequality. So though I am wireless, I cannot walk too far forward. That's exciting. So this is inequality in 1970 at the start of the recession. And what we see is that 1% of the population owns 17% of the wealth, makes 17% of income and has 30% of the wealth in the US. So inequality in wealth is at the most severest it's ever been since the 1920s, actually. Now, recessions tend to decrease inequality for a short time, but then things will go back to the way they were. So actually, inequality is still increasing. So we have increasing inequality, which we're probably most of us familiar with. But what causes income inequality? So demographic shifts are one of those things. That is, we've seen changes in the population. That means, so maybe we're growing more people who make less money have more kids. So we're having population shifts, and that increases inequality. Maybe that's what's going on. Maybe it's economic restructuring. Bennett Harrison talks about the great U-turn, where we've gone from in the manufacturing society to an economy that creates more service jobs and jobs that don't pay very much, thus enhancing income inequality. It could be that that technology has changed, and we don't have people who can work those jobs, again, enhancing income inequality. Maybe there are changes in institutions. So in the 1950s, 60s, and 70s, we had a very strong unionized movement in the US that went along with our manufacturing. There were progressive taxes, and there was a high minimum wage relative to income. That's no longer true. So my question is, what is housing's contribution? And again, housing is usually thought of it as the result of your station, rather than something that contributes to it. So let's talk about housing as a contributor to inequality. I'm just going to give you a little information about affordability. I did mention earlier that it's the biggest problem that we face in the US. So this is some data, a chart from the Joint Center on Housing from Harvard University. And they put out a report every year called The State of the Nation's Housing. And this is from their 2012 report. And this chart is the numbers of households who have severe cost burdens. That means they pay more than 50% of their income for housing. And this chart is the share within each of these categories who have a severe cost burden. So the first columns are folks who are households that make less than $15,000 a year. The middle, $15,000 to under $30,000. And then the last one, $30,000 to $45,000. And the same over here. And the colors are, the green is 2001, and we see 2007, which is the beginning of the recession, and then 2010. So we can see that regardless of year, the folks who make less than $15,000 a year, there are more of them certainly, and increasing numbers after the recession, who have these extraordinary housing cost burdens. But in every income category, we've seen that growth, even among the folks who, I mean, $30,000 to $45,000 is not necessarily wealthy, but they're still facing increased burdens. Percentage-wise, it's those folks in the bottom who are having the most difficulty. And percentage-wise, that share has gone up some, but you can see that, so what is it, so 68% of those who earn less than $15,000 a year pay more than 50% of their income for housing is what that means in 2012. And again, we've seen the same pattern, but it's much more extreme for the folks who are low income. But these are the folks who were benefiting from the subprime loans, not these folks, actually. There's a lot of nice buzzing today. So maybe I should just stay in one place where there's no buzzing. So in 75% of those cost burdens are folks who are in the lowest 20% of the income quartile in the US. And these folks here are single-parent homes who are poor, minority, and renter households, mostly. So why does it matter? Why does paying too much for housing matter? Because it means you can't spend money on other things. Michael Stone developed the term shelter poverty to describe the poverty that ensues when you spend too much on housing. So these are folks who are unburdened households, so these folks pay 30% or less of their income for housing, and the people in the red pay more than 50%. And we can see this is all these bars add up to 100%. So if you pay less for housing, then you can pay more for food, transportation, personal insurance, and health care. And if you pay too much for housing, you have a lot less to spend on those other things. So this is by way of saying that one of the contributions of housing to inequality is making it impossible to do other things other than just live in a house. How would you pay to go to school, for example, if you had that kind of an income structure? So let's talk about homeowners, though, the people who aren't on that chart, just for a minute, or maybe they are and they're low-income homeowners. So this is a chart also from, where's this one from? This is from the the housing survey that the census does, Bureau of Census does. And this tells the annual home ownership rates for the United States and the census regions from 1969 to 2011. I mentioned earlier that home ownership was something we encouraged. And so you can see, let's see, the US is this red line in the middle. Oh, and these shaded areas, those are recessions. So 1969 is down here, 2011 is up there. And we can see in the US, generally, we've had an increase in home ownership going up at the peak to about 68%, starting at about, what is that, 64% in 1969. The region, this region, that the Midwest has, aren't you guys lucky? You guys live in the region with the most highest rate of home ownership. That's that. The South is next, and then the Northeast has lower rates of home ownership, as does the West. And I show you this just to illustrate the effect of our deliberate policies to increase home ownership, and that the subprime lending was working very well. We really did increase our home ownership rates during this period. And then we see the recession and the fall off in those rates. But we can see regionally there were differences, but there are also demographic differences. Oops, wait a minute. No, we're good. So what are the benefits of home ownership? I've talked a little bit with you already about home ownership as a source of wealth. So places that have very higher rates of homeowners, those homeowners hopefully have more opportunity to build up equity in their homes. But you also get stable housing costs. So if you're a renter, your landlord can raise your rent. And then you have a choice. You accept the rent rate or you leave. So you pay more for rent and you get into that situation perhaps of housing shelter poverty. But if you're an owner, you get to have stable housing costs. And if you have a long-term 30-year loan, you have that for 30 years. And then you own your property and don't have a mortgage. You do have taxes, but that's another story. And this equity in a house that we really built our housing policy on allowed homeowners to deal with unexpected expenses. I remember before I owned my own home, going to visit my brother who owned a very nice house in Newton, Massachusetts. And he and his wife talking about where they were going to take the money from to buy something. Oh, let's take it from the home equity line of credit and write a check. It's a lot of flexibility that folks with homes have. Another relative of mine sold a house to pay for a college education. So there's some economic advantages and flexibility that comes with home ownership. The other thing you can do, as I mentioned, is deduct the interest. But there's a huge difference in income for renters and owners. So the net wealth of the median homeowner is 36 times greater than that of the median renter. So that's the people in the middle of the two distributions. So I would argue that our policies in increasing home ownership have probably also in some ways exacerbated inequality. But we'll see. Correlation is not causation. So I mentioned earlier that in homeownership and in subprime lending, all was not equal. And this is a chart of homeownership rates by race from 1994 to 2011. Again, by the Bureau of the Census. And 1994, 2011, this is a percent. The total is this red line. So again, here's the home ownership rate that you saw on the other chart. And the recession's marked. And the Great Recession starting around here, although I don't know why they have it in 2008. It should be down here somewhere. So this line that's above the total, that's the home ownership rate for non-Hispanic whites. For Hispanics and Latinos, that's the light green. Blacks, folks, so black alone is people who elected, said, I'm a black, I'm not any other race, just black. Their rate is down here. And all the races is this green. So this differential, when you take together the generations of home ownership for certain folks, clear differentials by race for other folks, there were some pretty thoughtful folks out there who said, in the early 1990s, we should be figuring out a loan that will allow us to expand credit to these people. And so they did. I like the word exotic loans. I find that to be very evocative. Subprime loans. So again, these are loans with higher interest rates than your normal fixed 30-year mortgage. They have flexible down payment and terms. You can put down less than 20%. There are some loans that during this period of lending that had no down payment. And higher fees. And these were for purchase, refinance, and for home equity. So they weren't just for one of those things. And this chart is from Dan Immergluck's book, Foreclosed, where he documents the history and how we got to the foreclosure crisis. The chart goes from 1993 to 2004, and it shows, what does it show? The way in which subprime lending became one of the most prevalent, it became a very popular way of lending. It shows the growth in the product. So the triangle here, this is a ratio, the axis here. So we started in 1993, and as we go out, these numbers are the ratio of the number of mortgages in that year that are subprime compared to the number of mortgages in 1993. Is that what it is? Oh, sorry, that's the next chart. Sorry, that's not this one. This one is, just a count of loans by subprime lenders. So we see that these are total purchase loans, and then the refinance loans are actually more frequent, and that's the total loans. I gave away my next slide, which is really, so subprime loans are increasing. I can go here. I am not cool with this. Here we go. So there is, of course, a distinct racial pattern in the use of those subprime loans. So this is the one that shows the ratio of loans compared to 1993. So the line with the diamond, that's the ratio of loans to black mortgage holders. So by 1998, there were 10 times as many mortgages for African Americans than there were in 1993. And these are subprime refinance loans. These are people who didn't elect to say what their race was. You can see that's like 25 times. The white is a triangle, and these are other minority. So they're growing in very, very quickly during this period, and they're growing unevenly. And of course, they're growing in ways, you've heard a lot about the abuse of these loans, right? That there were people who could have, the real abuse, so when does a subprime loan become predatory? That's really the question. It becomes predatory when someone can qualify for a better loan term, and they don't get it because of their race. And that's what happened a lot. So these started out in the 1990s. That's kind of the first wave of them. And they're mostly for refinance loans. And then they really peaked in 2006, 2007. And it was in the 2000s that we saw these exotic loans, meaning people really doing things that were very flexible, like, again, no money down, or having loan terms and like a one-year fixed credit, fixed interest rate, with another 15 years of variable, which can get you into a lot of trouble. So not only were there differential patterns in the use of subprime loans and differential patterns in our access to credit, we also have differential returns to home ownership as a benefit to folks. So when market conditions are favorable, meaning when prices are going up, which is what we thought would happen forever in the 2000s, there are, no surprisingly, better returns on home ownership than on other investments. So this is home ownership as a monetary instrument rather than as a home or a place that supports your kids going to school. Guess what? So that, if it's like that, yeah, you would tend to see less inequality. However, when market conditions are unfavorable, like now, for example, and the loans are predatory, so the terms aren't what they should be, and they're too disproportionately to minority buyers in racially segregated neighborhoods. So the other thing is in lower income neighborhoods, equity in a home prices don't rise as quickly as they do in neighborhoods that have higher housing values. So not only in unfavorable markets, but also sometimes in favorable markets do we see these kinds of differentials. And so we can imagine that in this situation, homeownership is going to exacerbate inequality instead of alleviate it. So our approach to looking at this was to try to predict county inequality, meaning that we have a data set, which I'm not going to show you any data today. Aren't you excited? We have a data set, a county data set that goes from 1980 to 2010, and we predict inequality using the Gini coefficient in 1990, 2000, and 2010, with conditions that existed 10 years prior. So if I want to know, my main hypothesis here, in question here, is does homeownership, does housing affordability, do subprime loans influence inequality, societal inequality? And if I want to know that, then I have to set up a situation where there can be some causation, perhaps, over time. And so we tried a 10-year time lag. The data, of course, support that. But there has to be some sort of change. And interestingly, when people usually model county inequality, they do it with data that's in the same year as the measure of inequality, which doesn't make sense to me if you're trying to predict what's going to happen. And we would think also that the impact is going to be different for larger and smaller places. So we look at those separately. So there are 796 big counties, and those big counties have populations of more than 65,000 in 2010. Oops. And we also have 2,272 small counties with smaller populations in 2010. The other reason we look at them separately is because of data quality issues. It's larger places, so we now get our data from the American Community Survey rather than the census. And it's very nice because that means we get looks at what's going on in the US in between the census years. So from 2000, 2010, I can see something that's going on. For larger places, there's sampling that goes on to make those estimates. And for larger places, the confidence intervals around those estimates is smaller because so you can get a 1-year estimate that's pretty good. But for smaller places, the confidence intervals are really big. And so we're less sure of our measures and of our results. So that was another reason we divided them out in this way. And we fit regression models to predict county-level inequality. And just in case you're interested, these were robust multivariate regression models to deal with spatial autocorrelation issues. And also, we used a fixed effect model with state-level fixed effects, also to deal with those spatial autocorrelation. So we used economic conditions, things like economic development, income and earnings differentials, the type of economy they had, whether there was a high unemployment rate, whether there was a high rate of dependence on government, manufacturing, real estate, and insurance, or service employment. We also used demographic variables, such as this question of skill-based technological change that I talked about earlier. So that's basically the high school completion rate, and also the variations in education that occur. And then, as I mentioned, geography, because places that are next to each other, let me go back up here. The other things we looked at for sociodemographics, of course, would be racial composition, ethnic earning differentials, age-based earning differentials, gender-based differentials, and additional things having to do with being female, the percent of female-headed households. So geography, places that are next to each other are pretty similar. That's spatial autocorrelation. And so we also think that counties and metropolitan areas are different from each other. So we have some metropolitan level variables. And we also think that census regions are different from each other, as well as having indicators for each of those states. And of course, because I'm interested in the housing, I represent housing dynamics. And we use basically the percent homeowner, the rate of homeownership, the rate of people who can't afford their home, housing cost burden, and we went to an awful lot of trouble to count subprime loans. So we have a measure of the proportion of subprime loans that were originated in that county in a year, 4 years before our observation year. So for the 1990s, we have data from 1996. And for the 2000s, our data, we actually have data from 2007 and 2006. Okay, results. So here's the results in a nutshell, if you can see the little print. Keep this in mind. That, yes, indeed, well, we argue that homeownership and affordability do contribute to later inequality, all else being equal. And that if used appropriately, subprime lending can have an equalizing effect on equality. Now, if you are interested, I'm not going to present any regression equations, but if you'd like to read such things, I have a copy of the paper that I could send you. So I'm just going to talk about the results. So one of the things we found is that homeownership's influence is inconsistent over time. And in those large places, places with populations of 65,000 or more, places that had more homeownership in 1980 and in 1990 actually did have less inequality in 1990 and 2000. So that was nice, right? We'd expect that. That was why we were doing those subprime loans in the 90s. Good thing. But in 2000 and 2010, things change. We see that places with more homeownership in 2000 had more inequality in 2010. Not surprising, right? Actually, this is what prompted us to start measuring the subprime crisis in this whole thing. And then housing affordability becomes important because in the 1980s, housing affordability has no relationship to later inequality at all. And then we see in 1990 and 2000 that places that are less affordable have more inequality in 2000 and 2010. These patterns don't exist in the same way for places that are small. In fact, homeownership doesn't matter as much in places that are smaller, maybe because there's fewer housing problems. Usually, housing cost is not the big problem for people in rural areas, but rather housing quality might be more the problem. So what's interesting, though, is that subprime loans also have an equalizing effect. And so places that had more subprime loans in the 90s, so we don't have subprime loans in the 80s, so we don't measure that, we don't look at that, actually had less inequality in 2000. And that only occurred, though, in markets that had high cost, actually in populous markets that had high costs. So in big places, if you could get a subprime loan and the housing costs were high, there was actually less societal inequality. But in the 2000s, if you had more subprime loans then, there was no impact on inequality in 2010. So what we did with the subprime market destroyed its benefits. So I'm going to give you a little bit of an example of this. So this is a chart for those larger counties. And we have two counterfactuals. So we have places, the dotted lines are for the dotted lines are for places that have low rates of subprime loans. And the solid lines are places that were really, really likely, that had a lot of subprime loans, had 90% or more subprime loans of all the mortgages that were originated in that county. And we can see from these lines, so this is the expected Gini, we predict inequality or the Gini coefficient, and we look at the cost of the market. So the more folks in that market that are housing cost burden, we would say the more expensive the market probably. And so we can see that inequality falls when we use a lot of subprime loans in expensive markets. But in markets where there aren't a lot of loans, inequality increases as housing cost increases. Things are very different in the next decade. So again, we have the dotted line for those that had low rates, counties with low rates of mortgages that were subprime, and the solid line. So we can see that it's still a negative relationship, but it's much flatter, much less effective. And then we can see that having relatively few subprime tends to be in places, and as housing cost burden goes up, inequality also rises. So what? Very nice. Okay. So there is a changing relationship that really surprised us. We did not go into this expecting to see this. Maybe that was naive, given what happened in the mortgage market. But we've concluded that homeownership may no longer have the wealth-creating benefits it once had. And the problem, though, is really affordability in populous, expensive markets, which is not all that surprising. And it turns out that we could argue that in expensive markets, used well, subprime loans can be an equalizing influence. That is, if they are not predatory. But in the wake of the foreclosure crisis, credit is hard to get. I remember I actually had problems getting my loan to move here because because of Fannie Mae guidelines that said I needed to be at my job for 30 days before I could get my loan. It's a whole saga. So credit's hard to get. And my boss at my old job, who was in her 60s, was too old to get a mortgage. So this lack of flexible instruments that allow banks to balance access to credit and risk is actually harming us right now, and in very real ways, especially when we think about inequality. And that is all I have to tell you today. I'm happy to entertain questions. Or comments. Go ahead.
With regard to, you kind of said that there were some obvious things about the negative impacts of subprime in expensive communities versus others. Is that just
It's the positive impacts of subprime.
Sorry?
The positive impacts of subprime.
Positive impact of subprime?
Right.
Is that just a reality of the number of subprime mortgages being prevalent in those communities versus others?
We actually don't know about the number, we just know about the proportion. So, in other words, I know that as a proportion of all loans that were originated in that year, in that county, there were relatively more subprime loans. So it could be that, that subprime loans, true, could have been more prevalent in these bigger, more expensive areas to begin with, right?
It's all about people trying to jump. I mean, that was always at least the news media description is people buying above their...
Yeah, that happened too. Those weren't always subprime loans. There were lots of reasons for the foreclosure crisis beside the subprime loans. Those just were like the icing on the cake. So the subprime loans, I don't know if you guys know about the secondary mortgage market. This is one of my favorite topics. So what happens is a bank lends money, and then somebody buys it. Like Goldman Sachs buys it. And they buy lots of these mortgages. And they bundle them into a security, which people invest in, right? Mortgage-backed securities. So there's actually a lawsuit in Michigan right now against Countrywide and Morgan Stanley, I think, for colluding on this to do this in African American communities and to create packages of loans that were higher risk and were more likely to fail. So the failure of the market was investing in these poor instruments. But we also had an increase in foreclosures because people lost their jobs. So there was this downward spiral that happened as a result. So is it the packaging and the mortgage-backed securities, or is it the use of the subprime loan? I mean, the secondary mortgage market is basically dead right now because of this. But it functioned really well with quasi-governmental agencies like Fannie Mae and Freddie Mac and Ginnie Mae. You know, for a very long time, it was pretty stable, and it created fluidity in banks' lending capabilities. And now we don't have that because we had all this abuse going on. I don't know if I've answered your question or not.
I guess in terms of, you know, I'm asking something that's maybe not in the numbers in the way that you look at them as percentages, but it just seemed a curious thing to think about subprime inequity as an issue in communities where perhaps lending was less active.
Right,
or,
right.
You know, at least in this time period.
That's right.
When we're really looking at, again, the kind of issue of people being convinced they can afford a house or being, you know, those types of issues.
I mean, both of those things are going on at the same time, right? There are people who are jumping, who are trying to get a better deal at a bigger house that has more cost, higher value house, into which they're putting no money, so they actually don't have any value in the house, right? They have no equity anyway. And then there are folks who didn't have access to credit before, and for them it's their first loan. Both of those things are going on. There was another hand in the middle, in the back, wasn't there? Go ahead, Charisma.
I was wondering if you could unpack a little more about the relationship between the prevalence of subprime lending and its impact on income inequality. Like the examples in the beginning, you know, you can understand how higher mortgages would impact consumption, but the Gini coefficient is a measure of income inequality.
That's right.
How is it that subprime loans are affecting the distribution of share?
So we have to, Jeannie, right, you have to make a lot of assumptions to get there, right? So what are the things that increase income inequality, right? That would be increasing wealth in one portion of the population, or increasing income in one group versus another. And to the extent that home ownership was associated with accruing or not accruing wealth, it would have influenced that. And because they were so tied up with wealth and income, we don't have a very good measure of wealth inequality, but income inequality is supposed to be very highly correlated with it. But you're right, I mean, the equity piece is really about wealth, but we don't have a measure of wealth. That's yeah, we talk about that in the paper, absolutely. What other questions do you have for me? Bernadette?
I was curious if there was if you looked at race and the origin of the subprime mortgages and how that was similar over the time period. You know, because we know that in the 2000s, I mean, it seems like there was a lot of emphasis on going after the minority populations to give these loans to.
Right.
Was that similar in earlier periods, or was there a difference?
We had a deregulation of the market in the 2000s. So
the practices became much more aggressive.
That's right. That's right. And you also had a lot more automation of practices. There was the what do they call it? Robo approvals, where you put the data into the system and it popped out what kind of loan you could get. So there was a lot more there was also technological change that made it possible to do this much more quickly. And subprime loans, rather than being used for home equity lines, which was what was going on, home equity loans, I'm sorry, which was what was going on in the 90s, started to be used for purchase. So a lot of things changed in how we use them. But it was the experience of the subprime loans in the 90s that caused policymakers to think there would be good ways of increasing access to credit. Unfortunately, we also had a lot of folks, so bank regulation, banks are very regulated, actually. And it wasn't the banks necessarily doing this lending that caused the problem, but rather private mortgage companies who were not part of that regulatory system, had a lot more freedom in who they could lend to. And it also wasn't the lowest income folks who were failing in their loans, because if they were getting loans and they were really low income, they were usually part of some sort of a community program, and they had been vetted and trained, and there was someone with them and making sure they didn't default. One of the reasons we started studying this was because there's this book by Eric Bilski, Inequality, which came out in the late 90s, called like Low-Income Homeownership, Achieving the Unachievable Dream. And I remember reading in it that we really need to be expanding this subprime lending so we can cover larger populations and deal with these differentials in homeownership. And the default rate isn't going to be that high. So this isn't a problem. It's not going to cost you too much. And I remember thinking about that, for obviously I thought about it for 10 years or more, that this was the hope, and it was a transition in how we used it that caused some of those problems. What other questions do you have for me?
I would like to suggest that if there are other questions, we adjourn to our refreshments. And also, those of you who are here for continuing education credit, be sure to sign up as you're leaving the auditorium. This is for landscape, not for architecture.
Or planning.
Okay.
Thank you.
Thank you very much.